Hello there, this is Trevor Patching. Welcome to my webinar, which is Protecting, Preserving Your Retirement in Volatile Markets. So let's get going. So today I'm going to teach you my 7-step process. At the end of this, you're going to be able to set up your own retirement plan, which will protect you from market volatility. So here's what you're going to learn. How to create your own retirement plan that's going to give you confidence and put yourself in control. How to create guaranteed income for life without guessing so you can enjoy a stress-free retirement, and how to mitigate the impact of stock market crashes so you can invest with confidence. I'm going to teach you my Grip It system. It's our way to protect and preserve your retirement. Now, if you're thinking that this is about getting rich quick, this is not for you. This is for you if you're still working and you want a retirement plan, or you still want to invest for growth and risk management. Maybe you're already retired and you're worried about running out of money and you want guaranteed lifetime income. Maybe you're worried about your investments and financial future because of the recent stock market crash and ongoing volatility. So who am I? I'm Trevor Patching, and I nearly got ruined in 2008 along with millions of other people in this country. I started this business in 2007. The stock market crashed in 2008. And I learned an awful lot of lessons, and everything that I learned, I created this new system based on the lessons learned in 2008, and I'll share more with you later. So my company, Asset Wealth Management, we are fiduciaries, which means that we have to act in your best interests. We are financial advisors registered with FINRA, and I am also a National Social Security Advisor certificate holder. So you might be thinking that this is just another financial advisor pitch, but I'm going to show you a process that no one is using and how you can do this for yourself. You might be thinking this is just another boring investment portfolio pitch, but I'm going to show you why the old school methods that you might be using don't work and how they're destroying your wealth. And maybe you're thinking, well, this is all well and good, but I'm okay with my financial advisor. Well, I'm going to show you what 99% of advisors don't do and what to do instead to protect your retirement. You're going to learn the Grip It system that preserves and protects your retirement in volatile markets and creates guaranteed lifetime income. At the end of the tutorial, I'm going to make you an offer to help you take action immediately. Now, we all know about the recent stock market crash and the volatility in 2020. And we know that stock market crashes and volatility create fear and sometimes make tough decisions. Are you one of the 76% of Americans who are concerned that they won't achieve a secure retirement? And the other questions I get when I have a stock market crash are questions like, do we have to cut back this month? Will we have enough now? What do we have to do? What if things get worse? Will my kids be okay? And the problem is that crashes are actually normal. They happen periodically, frequently, and it's something that we just have to find a way to deal with. We have more problems too. We have COVID-19, which is currently affecting the world. It's affecting the world markets. There's nowhere to run, nowhere to hide. The only safe place for your money is cash, but you don't make any money if you have money in cash. And what if this is the beginning of something way bigger? What I'm showing you now is the biggest stock market crash in history in the 30s. This was the Dow. The red line is the Dow. And what happened was the Dow crashed at a big crash. It then bounced back, and then it continued to crash and bounce back, going ever lower for 4 years. And on top of this is the blue line, which is the Dow of 2020. And you can see it crashed, it's recovered. Who knows? I don't know what's going to happen, but what if this is the beginning of something bigger? So all we do know is that there are huge uncertainties right now. We don't know how long this recession is going to last, how deep it's going to get, what's going to happen to the stock markets, what's going to happen to interest rates. Has the world economy changed forever? And are the assumptions that we've always used, are they valid anymore? Is the media helping? No. There's just so much bad information, fake news out there that it drives me and pretty much everybody else crazy. So all this does is create a very dangerous situation for people in what we call the retirement red zone. That's people that are within 5 years of retirement or within their first 5 years of retirement. And that's a really crucial time period. And I'll explain why later. So stock market's the problem. No, stock market crashes are not the real problem. The real problem is income. Let me explain. Think about the purpose of your retirement assets. What are they for? Well, in reality, you're only going to do two things with your retirement money. You're either going to spend it, create retirement income, healthcare purchases, lifestyle, etc., or you're going to give it away to a charity or to your beneficiaries. That's it. There's only two purposes, uses for your retirement assets. So if one of the purposes is to use it for retirement income, the question is this, and this is a truth. How you invest to create income in retirement should be different to how you save for retirement. So most retirees are actually using the wrong approach. Let's take Mount Everest as an example. So did you know that 90% of mountaineers who die on Mount Everest were actually coming down the mountain? And the reason they died down the mountain is that they have a different strategy. There's different skills required to get down than to get up. And think about this in terms of your own investing for your retirement. You spend 35 years accumulating money and you have strategies to accumulate money. However, when you retire and you then have to replace your check, your paycheck, with income from your retirement assets, that's the decumulation phase. You need a different strategy. And that's what we do, is help our clients safely down the retirement mountain. Now let's look at some of the risks involved here. We know that time is a huge risk. Before retirement, we know our time horizon. For example, if we are starting saving seriously for retirement at 35 and we want to retire at 65, we've got a 30-year window that we can pretty much put a plan together for our retirement. But once we hit retirement, then we don't know what our time horizon is. We don't know how long we're going to live. Are we going to make life expectancy, which is age 84? What if we get to 95 or even 100 or older? And there's a big chance that could happen. There's a 65-year-old couple has a 50% chance that at least one of them is going to live to age 92, and a 25% chance that at least one is going to live to age 97. I know my wife's family all lived in their hundreds. So I'm going to show you why using the traditional asset allocation advice is a wealth destroyer. You've probably been told that you need to focus on asset allocation and diversification. I'm going to show you why that doesn't work. Now, asset allocation, this and diversification, you've been told to have diversify into many different asset classes: large cap, small cap, mid cap, bonds, and so on. And the more pieces of the pie, the more color pieces of the pie you have, the safer you are because you're diversified. So if an asset goes down in value here, it'll go up in value over here. But that doesn't work. Remember 2008, the financial crash, every single asset class went down in value. So a systematic approach to diversification does not work. So what about creating a 60-40 stock bond portfolio? And you've probably heard about the safe withdrawal rate of 4%. If you take out 4%, adjust for inflation each year, you have a very good chance of not running out of money. But remember, all of this research and these theories, modern portfolio theory, are very old news. They were done 50, 60, almost 100 years ago, some of them, and it just doesn't stand up today. So modern research has shown if you do a 60-40 stock bond mix, you take out 4%, you actually only have an 80% chance of not running out of money. So to get a 96% chance, which is here, what's the safe rate of withdrawal? It's 3%. Now think about that. That's crazy. To get $30,000 of retirement income, they're saying you can only take out, you need $1 million, 3%. That's crazy. That's just crazy. That means if you need $60,000 retirement income, you have to have $2 million in assets. So that doesn't work. So traditional investing doesn't work for retirees. And forget the advice of using conservative approaches, dividends and bonds. Have you seen the interest rates that are being paid on bonds right now? I mean, they're in the dirt. And dividends? Well, what happened in the financial crash this year? Yes, many companies cut their dividends or even stopped their dividends to preserve cash. And a lot of retirees are using things like mutual funds and index funds, but they're at risk too. So let's look at some of these things. Mutual funds, they are a buy and hold play. But there's zero risk management. They're only built for offense. So if there is a stock market crash, the only person who's worried is you. And the only reason for that is this. The mutual fund cannot go to cash. The fund managers, smart people that they are, cannot sell and go to cash. They have to stay legally stay in cash, stay legally invested 95%. So in a crash, fund managers only have one option, and that is to try to buy less bad securities. But I hear you say index funds are the thing. Warren Buffett talks about index funds. What are index funds? Well, index funds are simply passively managed mutual funds. Yes, they have lower fees and no commissions, but they are still buy and hold, which means there is no risk management. So index investors capture 100% of every market crash. So buy and hold is really buy and hope. And if you buy and hope, you better hold on tight because you're going to go up and down with the market. So we talked about the first 5 years in the retirement red zone as being the high risk time for retirees. And this is down to what's called the lifetime sequence of returns risk. And what research has shown is that what happens in the first 5 years of retirement in terms of your returns really affect the outcome of your retirement. And I'm going to illustrate this with two hypothetical people, Bill and Steve. So Bill and Steve are brothers, and each of them has $500,000 in their IRA at retirement. And both of them are going to take out $30,000 a year for income. So Steve retires first. Steve retires in 1990. Here's Steve. And what Steve is invested in are index funds, so he's going to get whatever the market gives him. So in 1990, the return was minus 4.34%. He then took his $30,000 out. He was left with $449,000, and so on. After 10 years, Steve had $1,234,000 in his account. So he did really well. So Bill said, I'm going to retire too. But Bill retires in the year 2000. And in the year 2000, the return was negative 6.14. He took out his $30,000. He had $440,000 left. The returns were negative in 2001. He went down minus 7%. He still took his $30,000. Now he's down to 381. 2002, the market went down 16.76%. He still took his 30,000. Now he's down to 292. Then the market had a good year of 25% and so on. After 10 years, poor old Bill had $156,000 in his account. So look at the difference between Steve and Bill. Both invested in exactly the same way, taking exactly the same amount of money out of their account each year for 10 years. Steve had good market returns in the early years. He made 20% year two, 4%, and 13%. He did well. Bill had bad market returns at the beginning of his retirement. The difference between Bill and Steve was $1 million. $1 million difference. That's huge. So what do we do? So let's look at the real income risks here. We've got longevity risk. How long do your savings have to last? Remember, we talked about that's a really important thing. We don't know the answer to that. We just know that it could be a very long time. We know that there's something called a sequence of return risk. We've just learned that the impact of losses in the early years can really affect your portfolio and your retirement. So we don't know whether the next 10 years when we retire are going to be good, like Steve, or they're going to be bad like Bill. We have no clue. We don't know what the future's going to hold. We also know that we have to choose the right distribution plan to create the income that we need. And we also need to have an investment strategy. Are we going to buy and hold, or are we going to have some kind of active management? And lastly, what allocations should we choose? So what do we do? Well, despite the recent market crash and ongoing volatility, there are people just like you who are actually happy with their investments. So my aha moment came in 2008. Prior to that, all clients wanted was accumulation, make money, make more money, I want a higher return, and so on. And then we had the crash, and the fear that set in was palpable. And then the light bulb switched on, not just for me, but a lot of my clients too. And everyone realized that it didn't matter how much return that they were making on their investments or how much money they actually had in their retirement accounts. It was all about how much income that they had, how much guaranteed income that was going to hit their bank account every month, and having a plan that was built to withstand stock market crashes. And so based on my experience and my clients' experience, we developed this plan. And it's called the Grip It process. It's a 7-step process. I'm going to teach it to you now so that you too can apply our process to your life now. So let's get at it. So what does Grip It stand for? So Grip It stands for Guaranteed Retirement Income Plan plus Invest Tactically. So what do? Number one, we prioritize income as the number one objective. We establish a guaranteed income floor. So by that, we mean that we have guaranteed income that will pay all of our bills in retirement. That means that we can then invest the remaining assets entirely for growth. And by removing uncertainty, we believe we create peace of mind so our clients can retire confidently. So what are the 7 steps? Step 1 is we need to look at our budget. We need to understand our monthly expenses, our yearly expenses, and then factor forward to what they are going to look like in retirement. Step 2, we need to understand what sources of guaranteed income we will have at our retirement date. And there are only 3 sources of guaranteed income. One of them is Social Security, guaranteed by the government. Social Security is a big source of income, and we need to maximize and optimize that. And I'll show you how we do that a little later on. Then you need to look at things like pensions. If you have a pension, pensions are guaranteed. And the only other 3rd source of guaranteed income are annuities. That's what they're designed for. So you need to understand what guaranteed income am I going to get when I retire. Step 3, we call this find your gig. And your gig stands for your guaranteed income gap. And your guaranteed income gap is simply the expenses that you're going to have in retirement minus your guaranteed income from Social Security, pensions, and any annuities that you have. So once we know what the gap is, we now need to look at what assets do we have that we could use to potentially fill the gap. So we need to do a full audit of everything that we have, all our stocks, bonds, mutual funds, real estate savings, life insurance, and so on. Get that all on the table so that we understand what we have. Step 5, fill the gap. And by this, we are talking about the guaranteed income gap. If we have $1,000 a month guaranteed income gap, what we need to do is take the minimum amount of our assets and put them into a vehicle that's going to give us that guaranteed income when we retire. So if our gap is $1,000, we need to fill the $1,000 of income. If it's $2,000 and so on. What do we use to fill the gap? Well, we use the only thing that provides guaranteed income that we can control, and that is annuities. That's what they're designed for. So once we've filled the gap, we've created our retirement income plan, we've got our guaranteed income floor, we then invest the rest. I'm going to talk to you about how we invest in a second. And the last step is we monitor and refine the plan. So as a quick recap, these are our 7 steps. We look at our expenses now and in retirement. We quantify how much guaranteed income that we are going to get. And we understand and find out what the guaranteed income gap is. A full audit of all of our retirement assets. And then we take the minimum amount of assets needed to plug in guaranteed income. We invest the rest, and then we monitor and refine the plan. So, pretty simple, right? It is a simple process, but there's a lot of work involved. So what if you don't need guaranteed lifetime income? Or you want me to tell you, don't you? How do you invest the rest? And we mentioned before, it's about investing tactically. So I'm going to show you why I believe that tactically invested funds are the best strategy for investing if you are at or close to retirement. So what is invest tactically? We are talking about tactically managed portfolios. And this is for investors who want risk protection and a chance to outperform the market. Because tactically managed portfolios can be designed to do many different things, but specifically they're designed to manage the risk inside the portfolio and volatility. They have the potential to outperform a passive index or fund. And they use rules-based investing. These are called quant models, quantitative analysis models. And essentially, these quant models and rules-based investing takes emotion out of the decision-making process. So you haven't got to worry about whether the fund manager's had a bad day. These emotional pieces don't come into the equation. These are models that learn, fed thousands of pieces of data, and they make decisions based on what is going on in the economy. Now, they typically use ETFs for low cost efficient trading, but we can also use stocks to maximize tax efficiency. So the whole purpose about tactically managed portfolios, instead of buy and hold, if the stock market crashes, the fund can go to cash. It can and it will, depending on what kind of fund we have decided to put you in based on your risk tolerance. So the big question, of course, is, does it work? It sounds great in principle, but does it actually work? So let's look at some of the research. Active versus passive funds. My research tells me that actively managed funds outperform passively managed funds by nearly 2% a year on average. I mean, that's a huge difference. But more importantly, more than 2/3 of the time, actively managed equity funds are more consistent and less volatile than their counterpart passive funds. So let's show you an example. These are actually clients of ours who came and saw us last year. They were 62 and 52 at the time, and they were a new client in September 2019, and they did not have a retirement plan, and they were very concerned about the stock market. So we put them into our Grip It plan process. We did the whole 9 yards. We put a plan together. We optimized their social security. We optimized their tax planning. We put together a retirement income plan, and then we invested the rest tactically. So what I want to show you is this is one of their tactical portfolios. Here, remember, they came to us in September. In October, their statement shows that they invested with us whoops, I've covered it up, $451,000, 451, remember that. And they were 99% invested, okay? Factor forward, stock market crashed in the first quarter of 2020. The S&P was down 36%. S&P was down 36. Our account, or their account, was $447,000 as at March 31st. And then they were 82% in cash and cash alternatives. And the rest was actually a bond derivative. So what we did was, remember, they invested 451. At the height of the crash, they were at 447. So the tactically managed portfolio, the risk managed portfolio, did what it was supposed to do. It took them out of the stock market, put them into cash, and protected them from the downside risk. So here, I've just shown you now my 7-step process. I've shown the 7 steps that we do with our clients to help them preserve and protect their retirement, give them guaranteed income, protect them against volatility, and show them a way to invest where we can still mitigate volatility and take advantage of subsequent market returns. So my offer to you is this. If you're someone who really wants to preserve and protect your retirement, you might be wondering how you can do this today, quickly and easily, using all the tactics and strategies I just showed you. Well, my offer is I'm going to give you your own free Grip It call. At the end of the call, we will be able to give you a detailed Grip It analysis. We'll give you a bonus Social Security report. We're going to also give you a tax clarity report and a full portfolio analysis. I'll explain to you what all of this means. So our Grip It analysis comes out in the form of a full-blown detailed retirement plan. The retirement plan can run up to 30-odd pages, and it covers your income, your expenses, your assets, your liabilities, your cash flows, future at retirement. And it shows how we can build the plan scenario by scenario to create guaranteed lifetime income and still then invest for you, your family, and your legacy. Our tax clarity report is really important because we need to understand the taxation issues. How much tax are you paying? You don't want to overpay Uncle Sam. And why this is so important is that not a lot of people understand that Social Security is number one, it's tax. Secondly, it can be taxed up to 85% of your Social Security. And thirdly, it's taxed completely differently from ordinary income and investment income. And the way that those three types of income into play can make a huge difference in how much tax you pay. And so we want our clients to pay the minimum amount of tax legally possible. So we have to understand the taxation issues And we have this tax clarity report, which helps us do that. We do a full Morningstar X-ray analysis of your portfolio. And this is, again, a 26-page report. It deep dives into what you have, the risk, the benchmarks, and sometimes it can produce shocking results. So this lady, for example, she thought she was safe. She was actually very frightened of the market. She said, don't worry, I think I'm good. I'm in bonds. And see her bond portfolio here was, she had 60% of her portfolio in bonds. But when we took a deep dive, we saw that in actual fact, over 60% of it was junk. So oftentimes, people who come to us, they don't really understand what they are truly invested in and what the risk is that they have in their portfolio. Social Security is one of the biggest income assets you can get in your retirement years. And if you don't make the right decisions, it can cost you hundreds of thousands of dollars. So in this case, we have a software which allows us to run different scenarios. And in this case, we have different options for this couple. If they take it the earliest time, they get just over $1 million. If they take it at a later date, it's $1.4 million. That's a difference of nearly $300,000 of income. So how you take Social Security is important. Most advisors don't factor this into the consideration. For us, it's a key component of what we do. Our job is to optimize your Social Security strategies. So remember, this is my offer. This is a free call to enable you to put all the strategies and tactics that we discussed today in place really, really fast. We're going to give you a full retirement plan, a full GRIPIT analysis, the Social Security optimization report, a full tax clarity report so you understand exactly what taxes you're paying, what your marginal rate of tax is, and what investments you can make without affecting your next income tax band. And you'll have a full portfolio analysis. You'll understand exactly what you have, what risks you have, and we will also offer you some alternative strategies to put you in a better place. Now, our offer is limited to 10 people a month. So if you think that this is something that you want to do, that you are interested in having this kind of retirement plan and investment strategy, book a free strategy call now. Go to calendly.com/Trevor Patching. That's me. calendly.com/Trevor Patching. And if you have sent me a good email address, then I will reach out to you and also give you the ability to log a call with me. So remember, this is limited to 10 people. It's a fabulous offer. It's worth thousands of dollars. And it's something that we would do free for 10 people a month. So if you're interested in this, book your call now, calendly.com. I'll see you soon. Take care and be safe.